Quick note, this is for educational purposes only and not financial advice. Any decisions you make are your own responsibility, and trading involves risk. Most people think trading is about buying something low and selling it high. That is technically correct, but it is also dangerously incomplete. Because if that were all it took, everyone would be profitable. And clearly that is not the case. Trading at its core is not about price. It is about decision making under uncertainty. It is about interpreting information, forming a view, and then committing capital based on that view, while fully accepting the possibility of being wrong. When you strip everything back, trading is the process of exchanging risk. One participant believes an asset is undervalued, another believes it is overvalued. A transaction occurs and risk is transferred from one party to another. This is the foundation of every financial market in the world. Now here is where most beginners get it wrong. They focus on outcomes instead of process. They think success in trading means predicting the market correctly. But professionals do not think like that. They understand that trading is not about being right. It is about managing risk and probabilities over a large number of decisions. This is critical because the market is not a predictable system. It is a dynamic, constantly evolving environment driven by millions of participants, each with different objectives, information, and time horizons. So instead of asking where will price go, a professional trader asks what is the probability of this outcome and is the risk worth taking? That shift in thinking changes everything. In this video, the goal is to take you from a basic understanding of trading to a deep institutional level perspective of how markets actually function. Not theory for the sake of theory, but frameworks you can use to think, analyze, and act like a professional. By the end, you will no longer see trading as guessing price movements. You will see it as a structured decision-making process grounded in logic, discipline, and risk control. And that is where real progress begins. To truly understand trading, you need to understand what a market actually is, because without that foundation, everything else becomes fragmented and confusing. A financial market is simply a place where buyers and sellers come together to exchange assets. These assets can be currencies, stocks, commodities, bonds, or derivatives. But regardless of what is being traded, the underlying mechanism is always the same. Price moves because of imbalance. When there are more buyers than sellers, price rises. When there are more sellers than buyers, price falls. This is the most fundamental principle in trading, and yet it is often overlooked. But here is where it becomes more interesting. Not all buyers and sellers are the same. Some are institutions managing billions in capital. Others are retail traders operating from a laptop. Some are hedging risk, while others are speculating. Some are reacting to economic data, while others are following short-term momentum. This creates layers of intent within the market. For example, a central bank adjusting interest rates is not trying to make a profit from price movement. It is managing economic stability. A hedge fund might be positioning based on macroeconomic expectations. A retail trader might simply be reacting to recent price action. All of these participants interact in the same marketplace, and their combined activity is what creates price movement. Now, this is important because it means price is not random. It is the result of real decisions made by real participants, each acting on their own information and incentives. So when you analyze the market, you are not just looking at numbers, you are interpreting behavior. This is why professional trading is often described as understanding the why behind price movement, not just the what. Once you begin to see the market in this way, everything starts to make more sense. Price is no longer just moving up and down. It is reflecting the collective actions of participants responding to information, risk, and opportunity. And that perspective is essential if you want to move beyond basic trading and start thinking at a higher level. Now that the structure of the market is clear, the next step is understanding how trades actually happen. Every trade involves two sides, a buyer and a seller. For every position that is opened, there is someone taking the opposite side of that trade. This is a zero-sum environment in many markets, particularly in areas like foreign exchange and derivatives. That means one participant's gain is often another participant's loss. But the mechanics go deeper than that. When you place a trade, you are interacting with a system designed to match orders. These orders can be market orders, where you accept the current available price, or limit orders, where you specify the price you are willing to transact at. The interaction of these orders forms what is known as liquidity. Liquidity is the ability to buy or sell without causing significant movement in price. Highly liquid markets, like major currency pairs, have large volumes of buyers and sellers, which means transactions can occur quickly and efficiently. Less liquid markets can experience sharper price movements because there are fewer participants available to take the other side of a trade. This is where execution becomes important, because trading is not just about having an idea, it is about translating that idea into an actual position in the market with precise entry, risk, and exit parameters. Now, this is critical. Many traders underestimate the importance of execution. They focus entirely on analysis, but even the best idea can fail if it is executed poorly. Professional traders understand that execution is part of the strategy. It is not separate from it. They consider factors such as timing, liquidity, volatility, and positioning before entering a trade. They do not simply act impulsively. So when you think about trading, do not just think about predicting price. Think about how you interact with the market itself, because that interaction is what ultimately determines your results. At this point, it becomes clear that trading is not just about understanding markets. It is about managing uncertainty. Every trade you take is based on incomplete information. There is no scenario where you have full certainty about what will happen next. Even the most experienced traders operate with probabilities, not guarantees. This is where risk comes into play. Risk is not something to be avoided in trading. It is something to be controlled. When you enter a trade, you are effectively saying, I am willing to risk this amount of capital for the potential of this return. That relationship between risk and reward is at the heart of every decision. Now, this is where most traders get it wrong. They focus on how much they can make rather than how much they can lose. And that mindset leads to poor decisions, overexposure, and ultimately significant losses. Professional traders invert that thinking. They start with risk. They define exactly how much they are willing to lose on a trade before they even consider the potential profit. This creates a structured approach where losses are controlled and predictable. Over time, this is what allows a trader to survive, because survival is the first objective in trading. Without capital, there is no opportunity to improve, learn, or take advantage of future opportunities. This is why risk management is often described as the most important aspect of trading, not because it guarantees success, but because it prevents failure. And in a probabilistic environment, avoiding catastrophic losses is just as important as capturing profitable opportunities. Once you truly understand this, your entire approach to trading begins to change. Now, bringing all of this together, it becomes clear that trading is not a single skill. It is a combination of multiple disciplines working together. You need an understanding of how markets function. You need the ability to interpret information and form a structured view. You need the discipline to execute trades correctly. And most importantly, you need the ability to manage risk consistently. This is what separates amateurs from professionals. Amateurs often look for shortcuts. They search for the perfect strategy, the indicator that always works, or the secret that guarantees profits. But that approach ignores the reality of trading. There is no certainty. Professional traders accept this. They do not look for perfection. They look for an edge, something that, over a large number of trades, gives them a statistical advantage. This is where the concept of consistency comes in. Consistency in trading does not mean winning every trade. It means applying the same disciplined process repeatedly, regardless of short-term outcomes. This is critical, because without consistency, there is no way to measure performance, improve decision-making, or build long-term profitability. Trading, when done properly, becomes a structured process. It is no longer emotional or reactive. It is deliberate, controlled, and methodical. And this is the shift that every aspiring trader must make. From seeing trading as a way to make quick money, to understanding it as a professional discipline that requires time, effort, and precision. In the next part, the focus will move deeper into the core foundations that underpin successful trading, breaking down the key concepts that every trader must master before they can even think about consistency. Because this is where the real work begins. Before moving into more advanced concepts, it is essential to build a solid foundation around how traders actually form ideas. Because without a structured way of thinking, everything becomes reactive, inconsistent, and ultimately unprofitable. At the most basic level, every trade begins with a hypothesis, a belief about what might happen next in the market. But this is where the distinction between amateur and professional thinking becomes very clear. An amateur might say, price looks like it is going up, so I will buy. A professional approaches it very differently. They ask, what is driving this movement, and is there a logical reason for it to continue? This difference is everything, because markets move for reasons. These reasons can be macroeconomic, such as changes in interest rates or inflation. They can be driven by sentiment, such as fear or optimism. Or they can be technical, based on positioning and short-term behavior. But regardless of the source, a professional trader seeks alignment. They look for multiple factors pointing in the same direction. Not just one signal, but a confluence of information that increases the probability of a particular outcome. Now this is critical, because no single factor is reliable on its own. A piece of economic data might suggest strength, but if sentiment is heavily negative, the market may still move in the opposite direction. This is why trading is often described as a process of weighing evidence. You are constantly assessing different pieces of information, assigning them relative importance, and forming a balanced view, not certainty, but probability. And once that view is formed, the next step is equally important, deciding whether the potential opportunity is worth the risk, because not every idea should be traded. This is where discipline begins to separate those who succeed from those who struggle. The ability to wait, to filter, and to act only when conditions are favorable. That patience is not optional. It is a requirement. Once a trader has a structured way of forming ideas, the next step is understanding how those ideas translate into actual opportunities. This is where the concept of an edge becomes central. An edge is not a guarantee of profit, it is a statistical advantage. Something that over time and across many trades gives you a higher probability of success than failure. Now this is where most traders misunderstand the game. They believe an edge is something that works every time, but that is not how markets operate. Even the best strategies experience losses. Even the most experienced traders go through periods of drawdown. The key difference is that professionals expect this. They do not measure success by individual trades. They measure it over a series of trades where the law of large numbers begins to take effect. This is critical, because if you judge your performance based on a single outcome, You will constantly be misled. A losing trade does not necessarily mean a bad decision, and a winning trade does not necessarily mean a good one. What matters is whether the decision was aligned with your edge. If it was, then the outcome, whether positive or negative, is simply part of the process. This shift in perspective allows traders to remain objective, to avoid emotional reactions to short-term results, and to focus on executing their strategy consistently. Now, building an edge is not about complexity, it is about clarity. You need to understand exactly what conditions you are looking for, why they matter, and how they translate into a potential opportunity. Without that clarity, you are not trading with an edge, you are simply reacting. And reaction over time leads to inconsistency. With an edge defined, the next challenge is execution under real conditions. Because knowing what to do is very different from actually doing it. This is where psychology begins to play a major role. When real money is involved, decision-making changes. Emotions such as fear and greed start to influence behavior. Doubt creeps in. Hesitation appears, and discipline is tested. This is where most traders break down. They might have a solid understanding of the market. They might even have a well-defined strategy. But when it comes to execution, they deviate from their plan. They enter trades too early. They exit too late. They increase risk after losses. They hesitate when opportunities arise. All of these behaviors are driven by emotional responses. Now, this is critical because the market does not reward intention, it rewards execution. A perfectly designed strategy is useless if it is not applied consistently, and consistency is only possible when emotional interference is controlled. Professional traders understand this deeply. They do not try to eliminate emotions. That is not realistic. Instead, they build systems and processes that reduce the impact of emotions on their decisions. This might include predefined rules for entry and exit, fixed risk parameters, structured routines, and strict adherence to a trading plan. These frameworks act as a buffer between emotion and action. They create a level of objectivity that allows the trader to operate consistently, even under pressure. And over time, that consistency becomes one of the most valuable assets a trader can develop. Another key aspect of trading that is often misunderstood is time horizon. Not all traders are operating on the same time frame, and this has a significant impact on how markets behave. Some participants are focused on very short-term movements. They might hold positions for minutes or hours. Others are looking at medium-term opportunities over days or weeks. And some are positioned for long-term trends that unfold over months or even years. All of these perspectives exist simultaneously within the market. This creates complexity because a short-term price movement might be completely irrelevant from a long-term perspective, and a long-term trend might appear invisible to a short-term trader. Now, this is where alignment becomes important. As a trader, you need to be clear about your time frame. You need to understand what type of movement you are trying to capture and how that aligns with your strategy. This is critical because confusion around time frame leads to poor decisions. For example, entering a trade based on a long-term view but exiting based on short-term volatility, or taking a short-term position but expecting it to behave like a long-term investment. These mismatches create inconsistency. Professional traders avoid this by defining their approach clearly. They know exactly what they are looking for, how long they expect the trade to develop, and what conditions would invalidate their idea. This clarity allows them to filter noise, because not every movement in the market is relevant to your strategy. In fact, most of it is not. Learning to ignore irrelevant information is just as important as identifying opportunities. And that ability comes from understanding your time frame and staying aligned with it. As your understanding deepens, it becomes clear that trading is a process of continuous decision making. Every action or inaction is a decision that carries consequences. This includes not just when you enter a trade, but also when you exit, how you manage risk, and how you respond to changing conditions. Now, this is where adaptability becomes important. Markets are not static, they evolve, conditions change. What works in one environment may not work in another. This is where rigid thinking becomes a problem. If you are unable to adapt, you will eventually fall out of alignment with the market. And when that happens, performance begins to deteriorate. Professional traders understand this. They operate with structured frameworks, but they remain flexible within those frameworks. They continuously evaluate their performance, identify areas for improvement, and adjust accordingly. This is not about constantly changing strategy, it is about refining it. Now, this is critical because there is a fine balance between discipline and adaptability. Too much rigidity leads to stagnation. Too much flexibility leads to inconsistency. The goal is controlled adaptation, to make adjustments based on evidence, not emotion, to evolve your approach as your understanding deepens and as market conditions shift. This is what allows traders to remain effective over the long term, because trading is not something you master once and then repeat indefinitely. It is a skill that requires ongoing development, and those who commit to that process are the ones who ultimately succeed. Now, at this stage, it is important to bring everything back to one central idea. Trading is a game of probabilities, not certainties. And this is where many traders struggle, because human nature is wired to seek certainty. People want to know what will happen next. They want confirmation, reassurance, and guarantees. But the market does not provide any of those things. Instead, it offers uncertainty. Now, this is critical, because if you approach trading with a need to be certain, you will constantly feel uncomfortable. You will hesitate when you should act, and you will act when you should hesitate. Your decisions will be driven by emotion rather than logic. Professional traders solve this by changing how they think. They stop trying to predict exact outcomes. Instead, they focus on scenarios. They ask, what is most likely to happen and what will I do if I am wrong? That second part is just as important as the first, because being wrong is not a failure in trading. It is part of the process. The only true failure is not managing that risk properly. This is where probabilities become practical. If you know that your approach has a statistical edge over time, then individual outcomes become less important. You are no longer emotionally attached to each trade. You are focused on the long-term result. This creates a level of detachment that allows for consistent execution. You are no longer trying to win every trade. You are trying to execute your process as accurately as possible, knowing that the outcomes will take care of themselves over time. That is how professionals operate. And once you adopt this mindset, trading becomes far more structured and far less emotional. Now, building on this idea of probabilities, the next step is understanding how outcomes actually compound over time. Most traders think in isolated trades. They see each trade as a separate event, disconnected from everything else. But this is not how professional trading works. Professional traders think in sequences. They understand that their performance is the result of many trades, not just one. And within that sequence, both wins and losses are expected. Now, this is where consistency becomes powerful. If you have an edge and you apply it consistently, the outcomes begin to compound, not in a straight line, but over time with fluctuations along the way. This is critical because the path to profitability is not smooth. There will be periods of drawdown where losses occur consecutively. There will be periods where performance stalls. This is normal. What matters is how you respond during those periods. Amateurs often change their approach after a few losses. They lose confidence, abandon their strategy, and start searching for something new. This resets the entire process. Professionals do the opposite. They understand that short-term variance is part of the system. As long as their edge remains valid, they continue to execute. This is where discipline and patience come together. Because the real challenge is not identifying opportunities. It is staying consistent long enough for your edge to play out. And this is where most traders fail. Not because they lack knowledge, but because they lack the ability to stay consistent under pressure. Another fundamental concept in trading is understanding the difference between information and noise. Markets generate a constant stream of information. Economic data releases, news events, price movements, opinions, analysis. It is endless, but not all of it is useful. In fact, most of it is noise. Now, this is where clarity becomes essential. If you try to process everything, you'll become overwhelmed. Your decisions will become inconsistent and your focus will be diluted. Professional traders avoid this by filtering information. They identify what matters to their strategy and ignore everything else. This might include specific economic indicators, certain market behaviors, or particular conditions that align with their edge. Everything outside of that is irrelevant. This is critical. Because focus is a limited resource, the more you try to process, the less effective you become. By narrowing your focus, you increase the quality of your decisions. Now, this does not mean ignoring important information. It means being selective, understanding which inputs have a meaningful impact on your decision making and which do not. Over time, this creates a streamlined approach. You are no longer reacting to every piece of news or every movement in price. You are operating within a defined framework where only relevant information influences your decisions, and that is what allows for consistency and clarity in a complex environment. As your approach becomes more structured, it is important to understand the role of risk-reward in shaping long-term outcomes. Every trade you take has two key components: the potential loss and the potential gain. The relationship between these two determines how your strategy performs over time. Now, this is where a common misconception exists. Many traders believe they need to win most of their trades to be profitable, but this is not necessarily true. If your average win is significantly larger than your average loss, you can be profitable even with a relatively low win rate. This is critical because it shifts the focus away from being right and towards managing outcomes. Professional traders understand this deeply. They design their approach so that losses are controlled and gains are allowed to develop. This creates an asymmetry where the upside potential outweighs the downside risk. Over time, this asymmetry is what drives profitability. Now, this does not mean taking excessive risk for large gains. It means structuring trades in a way that makes sense relative to the opportunity. If the potential reward does not justify the risk, the trade is not worth taking. This level of selectivity is what separates disciplined trading from impulsive behavior. Because every trade has a cost, not just financially, but mentally and emotionally, and ensuring that each trade meets a defined standard is essential for long-term success. At this point, it becomes clear that trading is not about finding more opportunities. It is about identifying the right opportunities and executing them well. This is where selectivity becomes one of the most valuable skills a trader can develop. Most beginners believe they need to be active. They feel the need to constantly be in the market, taking trades, doing something. But activity does not equal productivity. In fact, excessive trading often leads to poor performance. Now, this is critical because the best opportunities in the market are not constant. They appear under specific conditions. When multiple factors align, professional traders spend most of their time waiting. They observe, analyze, and prepare. And when the right conditions appear, they act decisively. This patience is not passive. It is strategic. It allows them to avoid low quality setups and focus only on high probability opportunities. Now this requires confidence in your process, confidence in your edge, and confidence in your ability to wait without feeling the need to act. This is where discipline becomes visible, not in how often you trade, but in how selectively you trade. Because in trading, doing less can often lead to better results. And mastering that restraint is one of the key steps in becoming consistently profitable. As traders develop more experience, one of the most important shifts they must make is understanding the difference between outcome-based thinking and process-based thinking. Outcome-based thinking focuses on what happened. Did the trade make money or lose money? Was it a win or a loss? This is how most people naturally evaluate performance. But in trading, this approach is deeply flawed, because a good decision can result in a loss and a poor decision can result in a profit. If you judge your performance purely on outcomes, you will reinforce the wrong behaviors over time. Now this is critical. Professional traders focus on process. They ask, did I follow my rules? Was this trade aligned with my edge? Did I manage risk correctly? If the answer is yes, then the trade is considered successful, regardless of the outcome. This creates a stable feedback loop. You are no longer emotionally reacting to individual results. Instead, you are refining your process, improving your execution, and strengthening your discipline. Over time, this leads to consistency because your actions are guided by a structured framework, not by short-term results. This is where real progress happens. When you detach from outcomes and focus entirely on executing your process at a high level, that is how professionals evaluate themselves, and that is how long-term performance is built. Now, building on the idea of process, it is important to understand the role of routine in trading. Consistency in performance comes from consistency in behavior, and consistency in behavior is built through routine. Professional traders operate within structured routines that guide their daily actions. This might include reviewing market conditions, analyzing key drivers, preparing potential scenarios, and defining clear plans before any trade is taken. Now, this is critical because without a routine, decision making becomes reactive. You start responding to what is happening in the moment rather than executing a prepared plan. This leads to inconsistency, emotional decisions, and poor outcomes. A structured routine creates stability. It ensures that every decision is made within a defined framework, rather than being influenced by random events or emotional impulses. Over time, this reduces variability in performance. Now, routines are not rigid checklists that never change. They evolve as your understanding improves, but the principle remains the same. You are creating a repeatable process that guides your actions regardless of market conditions. This is what allows professional traders to operate at a high level consistently, not because they predict the market perfectly, but because they execute their process reliably. And that reliability is what creates long-term success. As structure and routine become established, the next layer to understand is the concept of feedback. In trading, feedback is not always immediate or clear. Unlike many other disciplines where cause and effect are closely linked, trading outcomes can be influenced by randomness in the short term. This makes learning more challenging. Now, this is where deliberate review becomes essential. Professional traders regularly analyze their performance, not just in terms of profit and loss, but in terms of decision quality. They review trades to understand what was done well, what could be improved, and whether their process was followed correctly. This is critical because without structured feedback, improvement becomes random. You might repeat mistakes without realizing it, or you might abandon good practices because of short-term outcomes. A disciplined review process creates clarity. It allows you to identify patterns in your behavior, both positive and negative. And once those patterns are identified, they can be reinforced or corrected. Now, this requires honesty. You need to evaluate your actions objectively without bias or emotional attachment. This is not always easy, but it is necessary if you want to improve, because trading is not a static skill. It is developed over time through continuous refinement, and feedback is the mechanism that drives that refinement. Another critical aspect of trading that is often overlooked is the concept of capital allocation. It is not just about whether you take a trade, but how much you allocate to it. Every trade represents a portion of your capital being exposed to risk, and how you distribute that risk across different opportunities has a significant impact on your overall performance. Now, this is where discipline becomes measurable. Professional traders do not allocate capital randomly. They use structured rules to determine position size based on factors such as risk tolerance, market conditions, and the quality of the opportunity. This is critical because poor capital allocation can undermine even the best strategy. If you risk too much on a single trade, a loss can have a disproportionate impact on your account. If you risk too little, you may not fully benefit from high quality opportunities. The goal is balance, to allocate capital in a way that allows for growth while protecting against significant losses. Over time, this creates stability. Your performance becomes less volatile and your ability to sustain long-term growth improves. Now, capital allocation is closely linked to risk management. It is not a separate concept. It is the practical application of how risk is distributed across your trading activity. And mastering this is essential for anyone looking to operate at a professional level. As all of these elements come together, a clear picture begins to form of what trading actually involves. It is not about predicting markets with certainty. It is not about finding perfect trades. And it is not about constant activity. It is about structured decision making, disciplined execution, and controlled risk. Now, this is where most traders reach a turning point. They either continue to approach trading as a series of isolated guesses, or they begin to treat it as a professional discipline. This decision determines everything that follows, because once you commit to a structured approach, your focus shifts. You are no longer chasing outcomes. You are building a process. You are no longer reacting to the market. You are operating within a defined framework, and over time, this creates consistency. Now, this is critical because consistency is the foundation of profitability. Without it, results are random. With it, performance becomes measurable, improvable, and sustainable. This is what separates those who struggle from those who succeed. Not intelligence, not luck, but the ability to apply a structured process consistently over time. And as the video continues, the focus will now move into how professional traders actually think, operate, and make decisions at a deeper level. Because this is where the gap between amateur and professional truly becomes visible. At a deeper level, what separates professional traders from everyone else is not just what they do, but how they think. Professional traders do not see the market as a place to prove themselves right. They see it as an environment to manage risk and extract opportunity. This is a subtle but powerful distinction, because when you approach trading with the need to be right, every loss feels like a failure. It becomes personal, and that emotional attachment leads to poor decisions. Now, this is critical. Professionals detach their identity from their trades. They are not trying to validate their intelligence or confirm their opinions. They are simply executing a process. They think in terms of scenarios. Instead of saying the market will go up, they say if these conditions hold, the probability of an upward move increases. If those conditions change, the view is invalid. This conditional thinking allows for flexibility. It prevents them from becoming anchored to a single idea, and it allows them to adapt as new information becomes available. This is how professionals remain objective. They are not reacting emotionally to market movements. They are continuously reassessing probabilities based on evolving conditions. Now, this way of thinking requires discipline, because it is easier to form a strong opinion and stick to it than it is to constantly evaluate and adjust. But the market rewards those who can remain flexible without becoming inconsistent. And that balance is what defines professional thinking. Another key characteristic of professional traders is how they handle losses. Losses are not avoided, they are expected. This is one of the most important mindset shifts in trading. Amateurs often try to avoid losses entirely. They move stop levels, hold on to losing positions, or refuse to accept that a trade is invalid. But this behavior creates larger problems. Now, this is critical. Professional traders accept losses quickly and move on. They understand that a small, controlled loss is simply part of the process. It is the cost of doing business in a probabilistic environment. What they avoid at all costs are large, uncontrolled losses, because those are the events that damage accounts and disrupt long-term performance. This is where discipline becomes non-negotiable. You must be willing to exit a trade when it no longer aligns with your original reasoning, not when it becomes emotionally uncomfortable, but when it becomes logically invalid. That distinction matters because it keeps your decisions grounded in process, not emotion. Over time, this approach creates resilience. You are no longer affected by individual losses. You understand that they are part of the system, and you trust your process to deliver results over a series of trades. And that trust is what allows you to remain consistent under pressure. Now, beyond individual trades, professional traders think in terms of overall exposure. They do not just consider the risk of a single position. They consider how multiple positions interact with each other. This is where the concept of correlation becomes important. If you take several trades that are effectively based on the same underlying idea, you are increasing your exposure without necessarily realizing it. For example, if multiple positions are influenced by the same macroeconomic factor, they may move in the same direction. This creates concentration risk. Now, this is critical because even if each individual trade appears well managed, the combined exposure can become excessive. Professional traders manage this by viewing their portfolio as a whole. They assess how positions are related, how risk is distributed, and whether they are overexposed to a particular theme or idea. This creates balance. It ensures that no single factor has the ability to significantly impact overall performance. Now, this level of awareness requires a broader perspective. You are not just managing trades, you are managing risk across an entire portfolio of decisions. And this is where trading begins to resemble professional capital management rather than isolated speculation. As this perspective develops, another important concept emerges: the idea of opportunity cost. Every trade you take uses capital, and that capital could have been used elsewhere. This means that every decision has an alternative. Now, this is where selectivity becomes even more important. Professional traders do not just ask, is this a good trade? They ask, is this the best use of capital right now? This is critical because taking a low quality trade does not just risk a loss. It also prevents you from taking a higher quality opportunity that may appear later. This is why patience is so valuable. By waiting for the right conditions, You preserve both capital and flexibility. Now, opportunity cost also applies to time and focus. If you are constantly analyzing irrelevant information or taking unnecessary trades, you are reducing your ability to concentrate on what truly matters. Professional traders optimize their attention. They focus on high impact decisions and ignore everything else. This creates efficiency. You are no longer spreading your resources thinly across multiple low quality opportunities. You are concentrating them where they have the greatest potential impact. And over time, this approach leads to better performance with less unnecessary effort. At this level, trading becomes less about action and more about control. Control of risk, control of behavior, and control of decision making. Now, this is where the concept of discipline reaches its highest level. Discipline is not just about following rules. It is about maintaining consistency in the face of uncertainty, pressure, and variability. This is critical because the market will constantly test your discipline. There will be times when you feel the urge to act outside of your plan, times when you doubt your approach, times when recent outcomes influence your confidence. Professional traders experience all of this. The difference is how they respond. They rely on their process. They trust the work they have done to develop their strategy, and they commit to executing it consistently regardless of short-term outcomes. This creates stability. Your performance is no longer driven by emotion or impulse. It is driven by a structured framework that you apply repeatedly over time. Now, this level of discipline is not developed overnight. It is built through experience, repetition, and continuous refinement. But once it is established, it becomes one of the most powerful advantages a trader can have. Because in a field where uncertainty is constant, the ability to remain consistent is what ultimately defines success. Now, bringing everything into practical application, the first step in real-world trading is preparation. Before any trade is taken, a professional trader already has a structured understanding of the market environment. They are not starting from zero in the moment. They have already analyzed key drivers, identified potential scenarios, and defined what conditions they are looking for. This is critical, because most poor decisions happen in the moment when there is no preparation, when a trader is reacting rather than executing. Professional traders reverse this. They do the majority of their work before the opportunity appears. They define what a valid setup looks like, what conditions must be present, and what would invalidate the idea. This creates clarity. When the market reaches those conditions, there is no hesitation. The decision has effectively already been made. Now, this does not mean blindly executing without thought. It means executing within a predefined framework. If the conditions are met, the trade is valid. If they are not, the trade is ignored. This removes a large amount of emotional interference because you are no longer deciding in the moment. You are following a plan that was created when you were objective and rational. And that is where the quality of decision making improves significantly. Once a trade is entered, the focus shifts from analysis to management. This is where many traders make mistakes. They spend a significant amount of time analyzing before entering a trade, but once they are in, they become reactive. They watch every movement, question their decision, and often interfere unnecessarily. Now, this is critical because once a trade is placed, the outcome is no longer fully within your control. The market will do what it does. Your role is not to control the market, it is to manage your position within it. Professional traders understand this. They define their risk before entering the trade. They know exactly where they will exit if they are wrong, and they have a clear understanding of how they will manage the position if it moves in their favor. This creates structure. You are not making decisions based on emotion or short-term fluctuations. You are following a predefined plan. Now, this does not mean ignoring the market. It means responding to meaningful changes, not reacting to noise. If the original reasoning for the trade remains valid, there is no need to interfere. If that reasoning changes, the position should be reassessed. This disciplined approach to trade management is what prevents small mistakes from becoming large ones. And over time, it plays a major role in maintaining consistency. After a trade is closed, whether it results in a profit or a loss, the process is not finished. This is where reflection becomes essential. Every trade provides information, not just about the market, but about your own decision making. Now, this is critical because without reflection, experience does not translate into improvement. Professional traders review their trades regularly. They assess whether the trade was aligned with their strategy, whether it was executed correctly, and whether the outcome was consistent with expectations. This is not about self-criticism, it is about learning. If a trade was executed well, that behavior should be reinforced. If mistakes were made, they should be identified and corrected. Over time, this creates refinement. Your process becomes more efficient, your execution becomes more precise, and your understanding deepens. Now, this requires consistency. Reviewing trades occasionally is not enough. It must be part of your routine. Because continuous improvement is what allows traders to evolve. And in a dynamic environment like the market, that evolution is essential. At this point, the full picture of trading should be much clearer. It is not about predicting price. It is not about reacting to every movement. And it is not about finding a perfect strategy. It is about building a structured process. A process that allows you to analyze the market objectively, identify opportunities based on probability, execute trades with discipline, and manage risk consistently. Now, this is critical because without structure, trading becomes random. With structure, it becomes measurable. And once something is measurable, it can be improved. This is what transforms trading from a speculative activity into a professional discipline. You are no longer relying on instinct or emotion. You are operating within a framework that is designed to produce consistent results over time. And that is the goal. Not short-term gains, but long-term consistency. Because that is what defines success in trading. To close, it is important to reinforce one final idea. Trading is simple in concept, but difficult in execution. The principles are straightforward. Understand how markets work, develop an edge, manage risk, execute consistently, but applying those principles under real conditions is where the challenge lies. Now, this is critical because success in trading is not determined by knowledge alone. It is determined by the ability to apply that knowledge consistently over time. This requires discipline, patience, emotional control, and a commitment to continuous improvement. There are no shortcuts. But for those who approach trading with the right mindset and the right structure, it becomes a skill that can be developed and refined. And over time, that skill can produce consistent, repeatable results. That is what professional trading truly is, a disciplined, structured approach to operating in an uncertain environment. If this perspective is fully understood and applied, it changes everything because you are no longer guessing. You are thinking, acting, and operating like a professional trader. And that is where real progress begins.